Federal Reserve makes its interest rate decision tomorrow. Gold is holding above $5,000 right now. Barely, but holding. And silver, sitting at a historically cheap ratio to gold, is waiting for a catalyst that could send it dramatically higher or pull it sharply lower. Tomorrow's Fed decision is that catalyst. By the end of this video, you will understand exactly what each possible Fed outcome means for silver, and what you should be doing before the decision comes out. My name is Stack AG. Let us get into it. Why Fed decision matters for silver. The Federal Reserve controls the price of money in the United States. When they cut interest rates, the dollar weakens. When they raise rates, the dollar strengthens. When they hold rates, markets interpret the language around that decision for signals about future direction. Silver responds to every one of these outcomes differently, and understanding exactly how, before the decision, is what separates investors who are prepared from investors who react emotionally after the fact. Right now, markets are sitting in what analysts are calling a tense equilibrium. Wall Street is uncertain about the near-term direction. Main Street investors are holding steady. Nobody wants to make big moves before knowing what the Fed says tomorrow. That uncertainty is visible in gold. Gold is under pressure from a liquidity crunch that is boosting the dollar ahead of the Fed meeting. When the dollar strengthens, gold and silver face headwinds because dollar-priced assets become more expensive for international buyers. But gold is holding above $5,100. That is not weakness. That is remarkable strength in the face of dollar pressure. And remarkable strength under pressure historically precedes explosive moves higher once the pressure is removed. 3 Fed scenarios, what each means. Scenario 1, Fed cuts rates tomorrow. This is the most bullish outcome for silver. A rate cut immediately weakens the dollar. Dollar weakness makes silver cheaper for international buyers. More buyers at lower effective prices means more demand. More demand against already constrained physical supply means higher prices. Additionally, a rate cut signals that the Fed sees economic weakness ahead. Economic uncertainty drives safe haven flows into precious metals. Gold moves first. Silver follows, and historically moves further and faster than gold once it catches a catalyst. If the Fed cuts tomorrow, silver's immediate reaction will likely be a sharp move higher. How high depends on the language accompanying the decision. An aggressive cut with dovish language could be the spark that begins the ratio compression we have been tracking for weeks. Scenario 2, Fed holds rates but signals future cuts. This is the most likely outcome based on current market positioning. The Fed holds rates steady but communicates clearly that cuts are coming in the next 1 to 2 meetings. This is a mildly bullish outcome for silver. Immediate market reaction may be muted or slightly negative as some investors who positioned for an immediate cut take profits. But the medium-term direction remains bullish because the fundamental rate cut trajectory is confirmed. Gold holding above $5,000 during a hold scenario would signal that the precious metals bull market is structural, not dependent on single Fed decisions. And structural bull markets in gold historically produce explosive moves in silver in the following months. Scenario 3. Fed holds and signals concern about inflation returning. This is the bear case scenario. If the Fed language shifts toward concern about inflation, implying that rate cuts may be delayed or reduced, the dollar strengthens. Gold faces pressure. Silver faces more pressure than gold because silver is more volatile and more sensitive to risk sentiment. In this scenario, silver could test lower support levels. A move toward the mid-70s is possible in the short term. This would not invalidate the long-term thesis, but it would create short-term pain for silver holders. Gold $5,100 support, why it matters. Gold holding above $5,100 ahead of the Fed decision is a critical technical and psychological signal. $5,000 is not just a round number. It is the level where significant institutional buy orders are clustered. Every time gold has approached $5,000 in recent weeks, buyers have emerged to defend that level. That defense tells you something important about institutional conviction in the precious metals bull market. When institutions defend price levels aggressively, it means they believe the asset is worth more than that level. They are not defending $5,000 gold because they think gold is going to $5,001. They are defending it because their models and their data tell them gold is going significantly higher, and they want to own as much as possible before it does. Silver's relationship to this gold support level is direct. If gold successfully holds $5,000 and breaks higher after the Fed decision, silver will follow, and silver's move will be larger in percentage terms than gold's move. Every single time this pattern has appeared historically, silver's percentage gain has exceeded gold's. Gold, holding $5,000 with silver at a 65-to-1 ratio, means silver has extraordinary mathematical catch-up potential. The longer gold holds this level, and the more institutional conviction is demonstrated by defending it, the more powerful silver's eventual move becomes. There is a second major story running alongside the Fed decision that most silver analysts are completely ignoring today. Wall Street is watching for an Iran breakthrough alongside the Fed meeting. Here is why this matters for silver specifically. For the past several weeks, geopolitical tension involving Iran has been adding a fear premium to precious metals prices. That fear premium has been supporting gold and silver above levels that pure monetary fundamentals might suggest. If a genuine Iran diplomatic breakthrough occurs, That fear premium gets removed from the market. In the short term, this could add downward pressure to gold and silver as the geopolitical safe haven bid weakens. But here's the counterintuitive reality that most retail investors miss completely. A reduction in Middle East tension removes the immediate fear premium, but it also stabilizes energy supply. Stable energy means lower oil prices over time. Lower oil prices over time reduce inflationary pressure. Reduced inflationary pressure gives the Federal Reserve more room to cut interest rates without worrying about energy-driven inflation. More room to cut rates means a weaker dollar over the medium term. A weaker dollar over the medium term is fundamentally bullish for silver and gold. Not immediately, not on the same day as the breakthrough, but over the following weeks and months. Short term, an Iran breakthrough removes the fear premium. Medium term, it opens the door to faster Fed rate cuts. And faster rate cuts are the most powerful fundamental driver of silver prices over any 6 to 12-month period. Understanding both the short-term and medium-term implications of geopolitical developments, rather than just reacting to the immediate headline, is what separates informed investors from emotional ones. Gold miners signal. What it means for silver. Here is a data point from today's Kitco news that most silver investors are not connecting to their silver thesis. 9-Point portfolio manager stated publicly today that gold miners could double in value even if gold bullion prices stall at current levels. This statement is significant for silver investors for a specific reason. When sophisticated portfolio managers make this argument about gold miners, they are telling you something about the underlying economic fundamentals of precious metals extraction. Mining companies are generating extraordinary cash flows at current gold prices. Their costs have not risen proportionally with gold prices. Their margins are expanding rapidly. Silver miners operate under the same economic logic. At current silver prices, silver mining companies with low-cost operations are generating significant free cash flow. If silver moves from $80 toward $100, the earnings leverage for silver miners is enormous. Their costs stay relatively fixed while revenue rises with every dollar increase in silver price. The smart money rotation into gold mining equities that 9-Point is describing, that same rotation logic applies to silver miners. Investors who understand leverage to commodity prices often move into mining equities before they move the underlying metal. Institutional money moving into precious metals, mining equities, is historically an early signal that the underlying metals are about to make significant moves. Watch the mining sector. When miners lead, metals follow. Gold is under pressure right now from what analysts are describing as a liquidity crunch ahead of the Fed meeting. Understanding what a liquidity crunch is and why it is temporary is essential for silver investors who are watching prices and wondering whether to be concerned. A liquidity crunch occurs when institutions and traders need cash quickly. They sell their most liquid assets first, which includes gold and silver futures. Not because they are bearish on gold and silver, because gold and silver futures are easy to sell quickly at known prices. This creates temporary selling pressure that has nothing to do with the fundamental value of silver or gold. It is mechanical, it is forced. And it reverses once the liquidity need is satisfied. Every major liquidity crunch in recent market history has been followed by a recovery and continuation in precious metals prices once the mechanical selling exhausts itself. The 2020 March crash saw gold and silver sold aggressively in the liquidity crunch, and then both recovered to new highs within months. Current liquidity pressure ahead of the Fed meeting is the same pattern. Temporary mechanical selling, not fundamental deterioration. The underlying drivers of the precious metals bull market, central bank buying, industrial demand, COMEX vault drainage, dollar weakness trajectory. None of those have changed because of a pre-Fed liquidity crunch. Knowing the difference between mechanical temporary pressure and fundamental deterioration is the single most important skill for precious metals investors. Today is mechanical temporary pressure. The fundamentals are intact. What to do before and after Fed decision. This is not financial advice. Always consult a qualified financial professional. Before the Fed decision tomorrow, the most important thing you can do is nothing impulsive. Do not make large position changes based on pre-decision speculation. Markets are often wrong about Fed outcomes, and even when they are right about the decision, they are often wrong about the market's reaction to it. If you hold physical silver, your position is not affected by tomorrow's Fed decision in any direct way. Physical silver in your possession has no counterparty risk, no margin call, no forced liquidation. You can hold through any short-term volatility that follows the decision without any consequence to your position. If you hold paper silver, futures, or ETFs, understand that volatility around Fed decisions can be sharp and fast in both directions. Size your positions accordingly. Do not hold more paper silver than you can emotionally and financially withstand seeing down 20% in a single session. If you are considering entering, waiting for clarity after the Fed decision is a reasonable approach. Once the decision and language are known, the near-term direction becomes clearer. Entering after initial volatility settles is often better than entering immediately before a major binary event. Dollar cost average regardless of timing. Small, consistent purchases over weeks remove the pressure of getting any single entry exactly right. We do not sell silver. We do not sell anything. Anyone claiming to be Stack AG and offering precious metals or investment products is a scammer. Block and report immediately. The Fed decides tomorrow. Gold is holding $5,000 under pressure. Silver is sitting at a historically cheap ratio waiting for a catalyst. 3 possible outcomes: 1 mildly negative short-term, 1 neutral with positive medium-term implications, 1 powerfully bullish. The independent data, COMEX vault drainage, industrial demand at records, managed money positioned long, gold-silver ratio historically elevated, all of that data does not change based on one Fed decision. The fundamental thesis is intact regardless of tomorrow's outcome. What changes tomorrow is the short-term price direction. And short-term price direction is noise for investors with a clear fundamental thesis and physical positions that require no margin maintenance. Stack AG will be here tomorrow, immediately after the decision. With the data analysis, you need to understand exactly what it means for silver. Subscribe. Hit the bell so you get that video the moment it publishes. I am Stack AG. Invest with logic, not hype. Say see you tomorrow.